All right, let's bring in Doug Flynn. He's a certified financial planner and the co-founder of Flynn Zito Capital Management, and he joins us now to talk about what could very well be an all-out trade war with China. Your thoughts, Doug?
Yeah, I mean, this is part of the negotiating that's going on. You're actually watching the process in action, and the markets don't really like that. They want to cut right to the chase, get to the bottom line, but it doesn't work that way. You have to work through this, and this is all a big part of getting to the ultimate deal that they want, which is to get a fairer deal for the United States. I think that's where we're going with this ultimately, but you're watching it play out, and that's what's causing the nerve-wracking reaction that we have right now.
Yeah, we can't escape this volatility. You either have pending regulation, the threat of regulation on the tech companies, or this tit for tat in terms of trade affecting how our markets are reacting. We can't escape it at all. So today we slapped $50 billion on their goods. In China, China responds with the same amount.
Yeah.
Are the Chinese tariffs getting to the heart of the problem, which is the theft of intellectual property and trade secrets?
No, I think in the end, you're probably going to get to the point that we actually do end up getting some movement on that, which has been a horrible situation for us. So matching it just offsets, and it can turn into a much bigger problem. But I think eventually they're going to both save face and come back with a great deal for everybody. And we're going to move ahead, but they're not going to have it play out that way on Chinese media. Look, the volatility, the quickest stat I remember from last year was we only had 10 days all of last year with greater than 1% moves. I think we're already at 40 days. And so volatility was already here, and this is just further exacerbating it. And so you can trade that, and that's an opportunity.
Right.
But it's sort of negative right now. The trend is not positive until they work through this.
That's a good point, Doug. But, when we have these whiplash, volatile sessions this year, does that erase the benefit, the tailwind that we've gotten from the tax cuts?
That's a great question, and the answer is absolutely not. As noisy and ugly as this is, the benefits of the GDP pickup, which this could put a damper on, but still is too strong. The tax cuts, remember, people just started seeing that money in their paycheck a couple of weeks ago, a couple of months ago. So that's just starting to trickle in. All the other benefits with productivity and production and the employment. There's so many positives that, yes, this is one negative. You put it on the negative side along with a couple of other things, and you put everything on the positive side, it doesn't equal or even outweigh it. So that's why this is an opportunity. When the market is off about 10%, which is where we're at, and you look at the long term, these are those points where you have to pick your point to get in, and maybe today is not the day, or partially it is, but those are the opportunities that you have. These are those times when you can take advantage of that, because the long term is not an offset. It is not yet anyway, unless it turns into something really bad.
We were just showing the futures board, and you can see all three major averages right now are down at least 1.5%. So this could very well be a 2+% down day for investors after the rebound, the recovery rally that we had yesterday, and it just makes it so quite honestly impossible to play this market. What do you make of the companies that could be most at risk here, whether it's Boeing, or Caterpillar, or 3M, or Nike and Starbucks, who quite frankly do a good chunk of their business and their overall revenue from China?
Yeah, it's a great point. You have to look at the diversification of the underlying companies, how much of their business comes from overseas and how much is specifically to that market. And they're going to have to work through this. I mean, it's not going to stop things from being sold, but it's going to put a damper on their sales for sure, which means they have to get more creative. They have to do more with diversifying into different countries. But I think we're going to work through this. It's like I said, it's the ugly process of working through it. And volatility is here, and you're going to see a bit of it, and hopefully things will settle down and we can move forward, which is what we're going to do.
And nervous investors buying gold today, that is certainly higher. Doug, thank you for your perspective on the breaking news this morning. Really appreciate it.
Another headline crossing.
Jason Barrsema is the co-founder and president of Halo Investing, and Doug Zito joins us once again as well. Good to see both of you. I'm bringing up the China reaction because now they've hit back. Their markets are closed. They've hit back dollar for dollar, 50 billion versus 50 billion. And whoa, the sell-off is pretty big this morning. Are you surprised, Doug, by Beijing's response here?
Maybe a little bit with matching it dollar for dollar, but I'm not surprised that they're all about how they look and how they appear to their people and saving face. So I think that it's kind of really, if you think about it, probably to be expected. And these are not done deals. They have to get to the negotiating table and work this all out. So,
Yeah.
But it is a salvo, and I think it sends a message, and that's why the market's reacting. So.
Yeah, the message, Jason, from China, the way I see it is we don't want a trade war, but we don't fear one either. Your thoughts?
That's exactly right. So if you were following along through the press conference with the Ministry of Commerce and Finance, they said, hey, we want to come back to the negotiating table, but if you want to fight, we'll fight to the end, which I think was their quote. But then as the conference wrapped up, they literally walked out and said, hey, well, let's see what the United States does in the next 60 days. We want to come to a reasonable solution. So I think the market is slightly overreacting.
And how we open does not indicate by any means how we close. That final hour, Doug, has become just so... fill in the word, right? And not only are we dealing with this trade issue, which is major in and of itself, we're also dealing with the tech issue.
Sure.
It's, and we're seeing a lot in a market that's moving down overall. I mean, the NASDAQ futures are down almost 2% right now. We do have those big tech stocks, Apple, Amazon, they're down sharply this morning in the pre-market. That affects things too.
It does. I think that, tech is, I've been saying for a while, when you have the kind of returns that you've had in technology over the last year or two, 30-something% last year, and so many other areas have not kept up. The tech as a part of the S&P being 25%, where's it going to go? Is it going to become 50% of the S&P? That's not going to happen. Other things are going to cycle back in. So it's not, unexpected that might lighten a little bit as people cycle into other types of investments. And that I think is also part of what's going on here.
Yeah. And Jason, final question here. Do you think that American consumers are going to be hit by this tit for tat between Beijing and Washington and the tariffs?
I think at the end of the day, the tariffs are going to be pretty watered down from what we're talking about today. So I don't see a huge impact on the U.S. If they go through of what they're talking about, yes, inflation will come in. I think that will impact the stock markets, as we've talked about. But I think right now it's a lot of rhetoric.
Jason, Doug Flynn, thank you, both of us, for sticking around with us this morning. And Jason, I hope you're right.
Hey, thank you. Me too.
So does my 401k.